Every economic pattern or significant shift in the economy or particular asset class usually has a pendulum effect. And like a rubber band, it can be stretched too far one way or the other. Today, we have a recoil taking place because of the apparent ceasefire and peace agreement that's expected to be signed this Friday between President Trump and whoever's in charge of Iran, which I'm still in doubt they really know who that is. But nonetheless, crude oil traders all over the world are trying to ascertain what that looks like in a post-peace agreement crude oil world. I know that many of you are looking at this saying, okay, well, what's the content? What am I getting from you today out of this message? Let me tell you what you're going to get. For every reaction, there's a counter reaction. For every pull to the high side, like we saw 90 days ago, there's going to be a pull to the low side. One thing that most people don't factor into any market condition is that the bulk of the market is not moved by retail investors. The bulk of the market is moved by institutions, governments, and long-term traders who are effectively changing the market to create an arbitrage that allows them to make substantial gains on minimal media information. A shot, a missile, a recoil, a peace agreement. It all changes the dynamics of crude oil. If you look at the last 45 days, oil prices have either gone up to $105 a barrel, down to 90, back up to 102, down to 95. And what that means is the market is not certain of the direction because it's holding its breath on one condition. Is there a peace agreement going to be signed? Quite frankly, I think it's irrelevant. What's relevant is what's really taking place around the world today. We have two wars that have been going on. They're burning ammunition and tanks and fuel and everything else that goes in terms of consumption regarding supporting a war. That's Russia, Ukraine, the Iranians, United States, Israel, and Hezbollah in Lebanon. We have all kinds of different things that are taking place in the commercial side of the global industrialized revolution that's taking on today. AI, artificial intelligence, data centers. The one thing that no one's telling you is that what's going on in the Strait of Hormuz is nothing more than the candle on top of the cake of future energy consumption. Now, you as an investor, you as an individual looking at where this is going needs to wake up and pay attention, because let me tell you what's taking place. They're talking out of both sides of their mouth. On one hand, they're talking about when this peace agreement is signed, oil prices are going to plummet. And then all afternoon on Fox News or any other business news channel, they talk about record-setting stock prices. SpaceX going public for $75 billion, valued at $2.35 trillion. And they're going to be launching rockets and building this. And they just acquired another AI firm for $65 billion this morning. We're talking $1 to $2 trillion in the United States alone is being spent for data centers to support AI, artificial intelligence, and data centers. Incredible amounts of money being spent. Well, what's behind that money? Why do they think oil prices are going to be cheaper long term? What supports the electricity in this country is the majority of electricity is supported by natural gas. The majority of the global demand these days is not crude oil, it's natural gas in the form of LNG, liquefied natural gas. What's more important to know is that every single one of these 500,000 electricians they're trying to hire and train, every one of these 500,000 welders and air conditioning specialists and specialists in construction and fabrication and manufacturing, they all drive diesel trucks. They burn fuel. They buy hammers. They buy welders. They buy equipment. If you look back in the history of the industrialized revolution since the 1700s, what it tells you is cheap energy fuels massive growth in economies. The problem is if your cheap energy is disrupted by geopolitical risk, if you look at the geopolitical risk in terms of either deteriorating or increasing, I don't see China making less battleships. I don't see Russia backing off the war in Ukraine. I don't see Ukraine burning less drones and blowing up less refineries. I don't see Iran giving up. I think they got Trump in a corner and made him take a peace deal that's probably much less than what he wanted. So what I do see is two things: geopolitical, global instability today, tomorrow, and probably for the next 20 years. China and Russia aren't going away. North Korea is not going away, and Iran's not going away. So the height of geopolitical risk means whoever has the oil, whoever has the electricity, whoever has the natural gas doesn't win the war. They win the war of energy. The other side of that is, while you're talking about commodity price and you're talking about the recoil from a 120-day war, no one's talking about the second side of their mouth, which is, oh, by the way, we're going through the greatest boom times in the history of the last 75 to 100 years. what's doing to the stock market. And they're bragging about stock prices up 200%, 300%. That's the same thing that happened back just before 2008 crash. It's the same thing they were talking about during the dot-com bubble. And what's really taking place is that the amount of cash being put out to the market is so enormous, the stock market should go up 500 to 1,000 points a day just by sheer volume of people participating. Today, you have people exiting a bond market. They're exiting because the bond yields are dropping as the war is potentially over and safety in investments and globally starts to become more of a potential reality. So if people are dumping billions upon billions of dollars, if not trillions around the globe, getting out of low-yielding bonds, they got to put it in something. It's either going to go to the public market in stocks, it's going to go into alternative assets like oil and gas, it's going to go into infrastructure for data centers or pipelines, but that money's coming out of bonds and it's flooding the market. You can't help but grow as a result of the money coming out of a liquid opportunity like a CD or a mutual fund, a money market or a bond. So what's really happening today is the recoil is this. Traders have traded oil down because they're long in their positions. They were anticipating a war that would last longer, be deeper, and less resolution. So anyone betting on long-term commodity price for crude oil are now dumping those positions. And if you think I don't know what I'm talking about, all you have to do is look back at 2020 during COVID. And traders that were in the long position at that time had to sell so many of their contracts, it went to negative $37 a barrel. They had to give somebody $37 a barrel to get out of the contract. That recoiled back into the $75 to $110 range over the next 3 years. But you combine a pendulum, a swing too far in the recoil from $110 oil back down to $77 like it is today, it may go down to $65 before we're done. But that swing back on the other side of that pendulum is going to be so far and so aggressive, and it's polar opposite to what's taking place in terms of demand. I'll make a prediction. The United States has been burning about 21 million barrels a day of crude oil for probably the last 1 to 2 years. I'll bet you in the next 5 years, based on data centers, we're up to 25 million barrels a day in the next 60 months. Why? Everything we're doing is consuming fossil fuels like it's nobody's business. It's like it's almost free. And President Trump will do everything he can in terms of interest rate manipulation and pressure to make sure that interest rates drop and make sure that oil and gas stays cheap. And when he's done, is going to find when he's left office, the next person in office is not going to be able to do that. And the recoil is going to be a spike in prices like no one's business. Because why? Oil companies feel the pain. When we get production and we get exploration costs and we get insurance costs and risk costs that are much higher than our actual return on investment, we slow down. We choke off wells. We stop drilling. We stop developing. We don't hire. We don't expand. We just stay the course. We keep our businesses running. But when it's all done and all this production is level, but we have an increase in demand like I just described, I'll bet you money that we're going to be somewhere north of $125 a barrel in 5 years. Because why? Because infrastructure and capital costs have been deprived in the oil and gas market globally for the last 15 years. And this little incident with Iran, and I say little only because it's short-lived, apparently, this little incident just highlighted with an absolute firework display how sensitive the entire globe is to the lack of crude oil at any given time for more than 60 days. The Achilles heel of the entire Western civilization and the free world has just been discovered. And those who want to disrupt free markets just found that out. I will tell you today, the recoil, the pendulum that's taking place, I fully expect it to last 30, 60, 90 days. I expect interruptions and spikes. But when it's all said and done, we have one thing that's underpinning the United States, an insatiable appetite for more crude oil, more natural gas, gasoline, and all the byproducts from a refined barrel of oil. And that appetite is going to grow and grow and grow, and exponentially over the next 5 years. It could be as high as 25 million barrels a day. So I don't care about Guyana coming online. I don't care about Vaca Muerta field in Argentina. I don't care about Brazil. What I care about is we're going to be missing about 3.5 to 4 million barrels a day of much needed supply that we may or may not be able to produce depending on what the price of crude oil is. We don't drill for free.